Look, we need to talk about something that just changed with your Social Security check. And I mean changed as of right now. While many view their Social Security checks as a constant in their budgets, the program itself is far from unchanging. And this January 1st brought 6 major rule changes that are affecting your money, whether you know it or not. Here's what nobody's telling you straight. Your benefits went up by 2.8%. That's about $56 more per month for the average retiree. But hold on, because Medicare Part B premiums jumped nearly 10% from $185 to $20,290, which means that cost of living increase. You just got a big chunk of it just walked right back out the door to pay for Medicare. That's the game. Nobody wants you to see clearly. But there's more. If you're working while collecting benefits, the earnings limits just shifted. You can now earn up to $24,480 before losing benefits. If you haven't reached full retirement age, that's up from last year. And here's the kicker for those of you born in 1960 or later. Full retirement age officially hits 67, starting this November, marking the end of a 42-year climb. Plus, there's a brand new $6,000 tax deduction for folks 65 and older that could save you serious money if you qualify. These aren't small potatoes. People, these are real dollars affecting real families trying to make retirement work in America today. Now let me talk to you straight about what this means for your retirement. See, I've been watching retirees get squeezed for years now, and this is the exact pattern I keep seeing play out. You get excited about a cost of living adjustment, somebody tells you your check's going up, and then reality walks through the door and takes half of it back. Before you even cash the check, it's like somebody putting an extra $20 in your wallet while they're picking your pocket for 15 of it. And folks, I need you to understand, this isn't some accident. This is the system working exactly as designed, and if you don't understand how it works, you're going to get worked over. Let's break down this COLA increase first because everybody's celebrating it like it's Christmas morning. Your Social Security benefits went up by about $56 per month on average. And that sounds great until you do the math. That's $672 more per year in your pocket theoretically. But here's where it gets real. Medicare Part B premiums jump from $185 to $20,290. Which means you're losing $1,790 every single month to Medicare before you even see your Social Security deposit. So that $56 increase, it just got cut down to $3,810. And we haven't even talked about the Medicare Part B deductible yet, which increased by $26 to $2.83 for the year. This is what I call the retirement trap. And millions of Americans are sitting right in the middle of it without even knowing they're caught. Here's what really gets me fired up about this whole situation. This is the 3rd straight year that Medicare Part B premiums have risen faster than Social Security's cost of living adjustment. Think about that for a second. For 3 years running, your healthcare costs have been outpacing the adjustments designed to help you keep up with rising prices. The government gives you a raise with one hand and takes it back with the other hand. And somehow, we're all supposed to act grateful about it. 77% of older adults said a 3% COLA wouldn't be enough to keep up with rising prices. And they were absolutely right. The 2.8% we got is even less than what people said they needed, and yet here we are trying to make it work. Now I want to talk to you about this full retirement age situation because this is affecting everybody born in 1960 or later. And if you're in that group, you need to pay attention in November 2026. Full retirement age hits 67 for people born in 1960 or later, marking the end of a 42-year climb in the retirement age. What does this mean? Practically, it means if you were born in 1960, you're not getting your full Social Security benefit until you hit 67 years old, not 66, and change, not somewhere in between 67 and if you claim early at 62, which I know a lot of you are tempted to do because you're tired, you're frustrated, maybe your job went away. You're looking at a 30% permanent reduction in your monthly benefit for the rest of your life. That's not a small hit, that's a knockout punch to your retirement income that you will never ever recover from. But here's what nobody's telling you about the earnings test, and this is critical information. If you're thinking about working while you collect benefits, if you haven't reached full retirement age, you can earn up to $24,480 in 2026 before they start reducing your benefits. And for every $2 you earn over that limit, they take $1 back from your Social Security. Now, if you're reaching full retirement age this year, that limit jumps way up to $65,160. And they only take back $1 for every $3 you earn over that amount the moment you hit full retirement age, though this whole earnings test disappears. You can make $1 million a year if you want, and they won't touch your Social Security benefit. Understanding these numbers could literally save you thousands of dollars. Let me tell you about this tax deduction situation because this is actually good news for a change, and I don't get to deliver good news about government programs. Very often there's a new $6,000 tax deduction for people aged 65 and older that reduces taxable income, and it's available whether you itemize or take the standard deduction. Now listen carefully to how this works, because the details matter if you're a single filer with a modified adjusted gross income up to $75,000 or a married couple filing jointly with up to $150,000. You can claim the full $6,000 deduction if you're married and both spouses qualify. That's $12,000 total. You can deduct. This is on top of the regular standard deduction and the existing extra deduction. Seniors already get combined with everything else. Single filers 65 and older can deduct a total of $23,750, and married couples can deduct up to $46,700. Now here's the catch, because there's always a catch with government programs. This deduction phases out for people with incomes above those thresholds, reducing by 6 cents for every dollar over the limit, and it's only temporary, running through the 2028 tax year. So you've got this year, next year, and the year after that to take advantage of this break. After that, unless Congress extends it, which they might or might not do, it disappears. This is why you need to be thinking strategically about your income right now. If you're considering doing a Roth conversion, if you're thinking about selling some investments, if you've got any flexibility, and when you recognize income, these next 3 years might be your golden window to do it while you got this extra deduction working for you. But I want to dig deeper into what this means for your actual tax bill, because just hearing about a deduction doesn't tell you what it's worth in real dollars. If you're in the 12% tax bracket, which a lot of retirees are, that $6,000 deduction saves you $720 in federal taxes. If you're in the 22% bracket, it saves you $1,320. That's real money. That's a mortgage payment for some people. That's a couple months of groceries. And if both spouses qualify and you're getting the full $12,000 deduction, you just doubled those savings now. I'm not saying this solves all your retirement problems, because it doesn't, but it's a tool in your toolbox, and if you're not using it, you're leaving money on the table that belongs to you. Let's talk about what this means for people who are still working, because I know many of you are. Maybe you want to work. Maybe you need to work. Either way, you need to understand how these earnings limits interact with your benefits if benefits get withheld because you earn too much. Social Security recalculates your benefit at full retirement age to give you credit for those months when benefits were withheld. So it's not like that money just vanishes into thin air. You do get it back eventually, but it's getting it back later instead of having it now, and that's a cost in itself. Time value of money matters. $1 today is worth more than $1 5 years from now, especially when inflation's eating into purchasing power year after year. Here's what I see happening with retirees right now that breaks my heart. People are making decisions based on fear instead of information. They're claiming Social Security at 62 because they're scared the money won't be there if they wait, even though claiming early locks them into a permanently reduced benefit, or they're avoiding work they'd enjoy. And that would help them financially because they're terrified of the earnings test without understanding that once they hit full retirement age, they can earn whatever they want, or they're not taking advantage of this tax deduction because they don't know it exists, or they think it's too complicated. Knowledge is power in retirement planning, and ignorance costs you real money every single month for the rest of your life. I need you to understand something about how these changes compound over time. Let's say you're getting the average Social Security benefit right now, which is around $2,071 a month after this COLA increase, but you're also paying that higher Medicare premium. So your net increase is only about $38 over a year. That's $456. That might cover some of your increased grocery costs, maybe part of your increased utilities, but it's definitely not keeping pace with your total cost of living. Increases your homeowner's insurance probably went up more than that. Your car insurance definitely went up more than that. Your prescriptions, your out-of-pocket medical costs, your property taxes. If you still own a home, all of these things are climbing faster than your Social Security adjustment can cover. This is the slow squeeze I am talking about, and it's why so many retirees feel like they're falling behind even when their checks keep going up. Now, let me talk to you about the taxable maximum, because this affects how much Social Security you're going to get down the road. If you're still working in 2026, you pay Social Security tax on earnings up to $184,500, up from $176,100 last year. If you're making wages, you pay 6.2% and your employer matches it. If you're self-employed, you pay the full 12.4% yourself. Everything you earn above that threshold doesn't get taxed for Social Security purposes, but it also doesn't count toward calculating your future benefits. This matters because your Social Security benefit is based on your highest 35 years of earnings. And if you're still working and earning good money, you might be replacing lower earning years from earlier in your career with higher earning years now, which increases your eventual benefit years. Something most people don't realize about the COLA calculation that drives me absolutely crazy. The cost of living adjustment is based on the Consumer Price Index for urban wage earners and clerical workers. Read that again: urban wage earners and clerical workers, not retirees, not people living on fixed incomes, not people whose spending patterns are dominated by healthcare costs that rise way faster than general inflation. They're calculating your cost of living adjustment based on what working people are spending money on. And then they wonder why retirees say it's not enough. It's like measuring how much it costs to feed a family of 4 and using that number to decide how much to give somebody who lives alone. The math doesn't work because the situations aren't comparable, and let's be real about healthcare costs for a second, because this is where retirees are getting absolutely hammered. A person retiring in 2025 needs more than $172,000 saved just to cover healthcare expenses in retirement, and that's a 4.5% increase from the year before. That's not including long-term care. That's not including nursing home costs if you need them. That's just basic health care. Meanwhile, the purchasing power of Social Security benefits has dropped about 20% since 2010. You're getting dollars that buy less than they used to. You need more of them for health care, and your cost of living adjustments aren't keeping pace. This is not a sustainable situation, and pretending it is doesn't help anybody. What kills me is watching people go into retirement without a plan for how they're going to handle these annual changes. You cannot just set it and forget it. With Social Security, every year brings new numbers, new COLA adjustments, new Medicare premiums, new earnings limits, new tax rules. If you're not paying attention, you're going to miss opportunities to optimize your situation, and you're going to get blindsided by costs you didn't anticipate. This $6,000 tax deduction that just appeared. How many retirees do you think know it exists? How many accountants are going to proactively tell their clients about it? How many people are going to miss out on real tax savings because nobody told them to look for it? I want you to think about this tax deduction strategy for a minute because there's real planning opportunity here. This deduction reduces taxes on all your income, not just Social Security. So if you've been thinking about taking money out of your traditional IRA, if you've got some stocks you want to sell, if there's income, you have flexibility over the next 3 years, while this deduction is available, might be the smartest time to recognize that income. You've got a bigger deduction to offset it. You're potentially in a lower effective tax bracket because of it, and if you can use this window to do some Roth conversions, you're setting up tax-free income for later in retirement when you might not have this deduction anymore. This is the kind of strategic thinking that makes a huge difference over the long haul of retirement. But you've got to know the rules to play the game, right? Let me tell you what happens to people who don't understand the earnings test. They go back to work part-time. Maybe they're making $30,000 a year doing something they enjoy, and they're also collecting Social Security early. Well, if they're under full retirement age and they earn $30,000, that's $5,520. Over the limit, the Social Security Administration takes back $1 for every 2 over the threshold. So they're losing $2,760 from their annual Social Security benefits. They didn't plan for that. They didn't budget for it. Now they're scrambling to figure out how to cover expenses they thought Social Security would handle. And meanwhile, they could have just waited a few more years to claim benefits, worked as much as they wanted, and collected a bigger check for life once they hit full retirement age. But nobody explained the math to them. And now they're stuck with a permanent reduction in benefits they didn't need to take. Here's the bottom line that I need every person watching this to understand: Social Security is not simple. The rules are not intuitive. The annual changes matter, and the decisions you make about when to claim, how much to earn, how to handle your taxes. These decisions echo through the rest of your retirement. That $56 average increase you got this year, by the time Medicare takes its cut, by the time inflation eats away at the purchasing power, by the time you factor in all your actual costs going up, you might be treading water at best. But if you understand how to use that $6,000 tax deduction, if you know the earnings limits and can plan around them, if you're strategic about when you claim based on your full retirement age, you can add thousands of dollars per year to your actual spendable income. That's the difference between just surviving retirement and actually thriving in it. And it all comes down to knowing what you're dealing with and making informed choices instead of just hoping it works out. This isn't about being pessimistic. This is about being realistic, being prepared, and being smart with the resources you've got, because at the end of the day, this is your retirement, your money and your future. Don't leave it to chance when you can actually understand the system and make it work for you, as reported by the channel USA SecureBenefits. These developments represent significant shifts in the landscape of retirement planning for millions of Americans. The 2.8% increase in benefits, while welcome, is tempered by the substantial rise in Medicare Part B premiums, which have outpaced cost of living adjustments for the 3rd consecutive year. This disparity highlights ongoing challenges in maintaining financial stability during retirement, particularly as healthcare costs continue to escalate faster than general inflation. The adjustment to full retirement age, reaching 67 for those born in 1960 or later, underscores the gradual extension of working years required to access full benefits, a change that has been unfolding over 42 years. This shift necessitates careful consideration for individuals approaching retirement age, as early claiming at 62 could result in a 30% permanent reduction in monthly benefits, potentially impacting long-term financial security. The updated earnings limits offer some flexibility for those who choose to work while receiving benefits, allowing earnings up to $24,480 without penalty before full retirement age, and significantly higher at $65,160 for those reaching that milestone in the current year. Importantly, these limits dissolve entirely upon attaining full retirement age, enabling unrestricted employment without benefit reductions. The introduction. of the $6,000 tax deduction for individuals age 65 and older provides a valuable opportunity to reduce taxable income, applicable regardless of whether one itemizes deductions or opts for the standard deduction. This benefit extends to $12,000 for qualifying married couples and stacks atop existing deductions, potentially allowing single filers to deduct up to $23,750 and joint filers up to $46,700. However, its phase-out for incomes exceeding $75,000 for singles or $150,000 for couples and its temporary nature through 2028 emphasize the need for timely strategic financial planning, such as Roth conversions or income recognition to maximize savings. The recalculation of benefits at full retirement age to credit withheld amounts due to excess earnings ensures that such funds are not lost but deferred, underscoring the importance of understanding the time value of money in retirement decisions. The basis of cost of living adjustments on the Consumer Price Index for urban wage earners rather than retiree-specific spending patterns contributes to perceptions that these increases fall short, particularly given the dominance of healthcare in retiree budgets, where costs have risen markedly, with estimates indicating over $172,000 needed for healthcare in retirement. Excluding long-term care, the decline in purchasing power of benefits by 20%. Since 2010 further exacerbates these pressures, the taxable maximum rising to $184,500 affects future benefit calculations by capping contributions and credits on earnings above this level, while potentially boosting benefits for high earners through replacement of lower past years. The overall system demands proactive engagement to navigate annual changes, effectively avoiding common pitfalls, like fear-driven early claiming or underutilization of available deductions as conveyed through USA SecureBenefits. This information aims to empower retirees with the knowledge to optimize their financial outcomes in an evolving policy environment. The recent adjustments to Social Security and related programs as of January 1st warrant close attention from beneficiaries. The cost of living adjustment of 2.8%, translating to an average monthly increase of $56 or $672 annually, is offset by the Medicare Part B premium rise from $185 to $20,290, resulting in a net monthly gain of approximately $38 after accounting for the $1,790 increase in premiums. This net effect illustrates the erosive impact of healthcare costs on retirement income, with the deductible also climbing by 26 to 2.83. The pattern of premiums, surpassing adjustments for 3 years running, aligns with survey data, where 77% of older adults indicate a 3% increase would be insufficient, underscoring a broader inadequacy in addressing inflation. The full retirement age, finalizing at 67 in November for 1960 births, concludes a long-term policy evolution requiring delayed claiming for unreduced benefits and imposing steep penalties for early access. The earnings test thresholds updated to $24,480 and $65,160, respectively, provide guidelines for balancing work and benefits with penalties of $1 per 2 or 3 over the limits. But full credit restoration at retirement age mitigates long-term loss, though deferral affects present value. The new deduction of $6,000 phasing out above income limits and expiring post-2028 offers tax relief valued at $720 to $1,320 in savings, depending on bracket, encouraging strategic income management. The mismatch in COLA methodology, failing to reflect retiree healthcare emphasis, contributes to the 20% purchasing power erosion since 2010, while healthcare savings needs rise by 4.5% to over $172,000. The taxable cap increase to $184,500 influences high earners' benefit accrual through 35-year averaging, as highlighted by USA SecureBenefits retirees must remain vigilant to leverage these rules, avoiding suboptimal decisions that compound over time. The implications of these changes extend to daily financial planning for retirees. The modest gross increase diminished by premium hikes leaves many struggling with escalating costs in insurance, utilities, and medical expenses. The retirement age solidification at 67 demands reassessment of claiming strategies to avoid irreversible reductions. The earnings provisions allow for supplemental income without total forfeiture, but require precise calculation to prevent unexpected withholdings. The tax break serves as a temporary buffer against taxable income, urging actions like conversions within the window to secure future tax advantages. The COLA basis on non-retiree indices perpetuates shortfalls in adjustment efficacy, amplifying the squeeze from health-dominated budgets and diminished benefit value. The cap elevation supports potential benefit enhancement for ongoing workers, but caps contribution above the threshold as per USA. SecureBenefits informed navigation of these elements is essential to transforming potential setbacks into managed opportunities for financial resilience in retirement. The convergence of these policy updates signals a critical juncture for Social Security recipients. The benefit uplift, though positive, is largely neutralized by the premium surge, creating a net increment, insufficient for comprehensive cost coverage. The age threshold completion at 67 reinforces the need for prolonged workforce participation or careful timing to preserve benefit integrity. The work limits expansion affords greater earning leeway pre- and at retirement age, with eventual elimination post-attainment, ensuring flexibility for those needing or desiring employment. The deduction innovation reduces liability across income sources with bracket-dependent savings and couple doubling, but its bounded duration and phase-out necessitate immediate planning. The index misalignment with retiree realities sustains inadequacy perceptions amid rapid health cost inflation and power loss. The savings requirement, escalation for medical needs, highlights unpreparedness risks. The payroll ceiling rise facilitates higher benefit computation for select earners via historical averaging, as emphasized by USA SecureBenefits. Proactive awareness and application of these dynamics can mitigate adverse effects, fostering a more secure retirement framework. The detailed examination of these modifications reveals interconnected challenges and opportunities within the system. The COLA provision intended to counter inflation falls short when undercut by premium growth, leading to minimal net gains and persistent affordability strains. The retirement age benchmark now fixed prompts reevaluation of life plans to optimize income streams. The earnings framework, structured with progressive limits and credit mechanisms, supports hybrid work retirement models, but demands meticulous adherence to avoid temporary losses. The fiscal relief via deduction targets, senior demographics offering substantial reductions in tax burden, particularly for moderate incomes, yet its ephemeral status calls for expedited utilization. The calculation methodology, rooted in working population metrics, diverges from senior expenditure profiles, exacerbating mismatch in adjustment. Impact the health expenditure projections underscore the imperative for supplemental savings beyond program reliance. The contribution limit adjustment enhances prospective benefits for active contributors by broadening creditable earnings as articulated through USA SecureBenefits. Mastering these intricacies equips individuals to make decisions that enhance long-term prosperity amid systemic complexities. The synthesis of these alterations underscores the necessity for continuous education on program evolutions. The benefit augmentation tempered by cost escalations exemplifies the delicate balance in retirement funding. The age parameter finalization at 67 encapsulates decades of policy progression influencing claiming behaviors and income projections. The income thresholds for benefit retention provide a scaffold for sustained employment with safeguards against permanent forfeiture through later adjustments. The tax incentive introduces a layer of relief in income management with potential for amplified savings in joint scenarios, but constrained by income caps and timeline. The inflationary measure tailored to non-seniors perpetuates discrepancies in cost alignment, contributing to eroded efficacy. The medical cost trajectory demands robust planning to bridge gaps in coverage. The tax base expansion for Social Security bolsters future entitlements for those in peak earning phases by integrating elevated years into formulas. As conveyed by USA SecureBenefits, diligent engagement with these factors empowers beneficiaries to navigate the landscape, effectively securing optimal outcomes in an ever-shifting retirement paradigm.